SanDisk just did something that should make you more nervous, not less. After running up more than 1,000%, the stock finally caught up to Wall Street's price targets. Analysts now think it's worth roughly what it costs. That sounds like the all clear. It's actually the setup for the trap. Everyone is asking the same question about SanDisk. Is this a real structural AI winner, or just another memory cycle that eventually crashes back to Earth? Here's the problem. That's the wrong question, because it forces one answer onto two completely separate decisions. The first decision is whether SanDisk sits in a future-defining sector. The second is whether today's price is a place to start buying. The market keeps blending those two into one yes or no. We're going to keep them apart because when you separate them, SanDisk gets a very clear, very uncomfortable verdict: a qualified sector and a disqualified price. Let me show you exactly how we get there. SanDisk spun out of Western Digital in February 2025 as a pure-play NAND flash and SSD company. No hard drive business, no mixed story, just the storage layer of computing. And that purity matters, because almost all of its revenue rides a single variable: NAND pricing. Now, it doesn't build its own fabs. It sources wafers through a decades-long joint venture with Kioxia, recently extended through 2034. That capital-light structure is why SanDisk threw off free cash flow margins near 50% last quarter while spending almost nothing on capex. So don't think of SanDisk as a boring parts supplier. Think of it as picks and shovels for the AI data center, with a contract backlog underneath it. Because here's the line that frames everything: if there's no memory, there's no AI. The GPU gets the headlines. The storage layer is what holds the data the GPU is trained on. Last quarter, SanDisk printed numbers that look fake for a memory company. Revenue up 251% year over year. Gross margin of 78.4%. Free cash flow around 50% of revenue. Zero debt. Net cash on the balance sheet, and a $6 billion buyback approved. Data center revenue alone exploded 233% quarter over quarter. And in April 2026, SanDisk was added to the NASDAQ 100, replacing Atlassian, which means index funds are now forced buyers. On paper, this is no longer a memory company. It looks like a software business, and that is precisely where the danger starts. Here's a fact worth sitting with. A commodity memory company has never sustained a 78% gross margin. Ever. Historically, these businesses run 40 to 50% at the good times. So this margin is not the company's constitution. It's the cycle's gift. And every tight memory cycle in history has ended the same way. High margins attract capacity. Samsung and SK Hynix and Micron and Kioxia all expand. And 2 years later, you're staring at oversupply and collapsing prices. Worse, you don't even need the physical oversupply to arrive. The moment the market believes expansion is coming, the multiple gets cut first. So the very thing bulls celebrate, that gigantic margin, is the single clearest marker that you're standing near a cyclical peak. Bulls love to point at the multi-year contracts, over $41 billion of remaining performance obligations, plus $11 billion in financial guarantees. And it does improve visibility. But people hear $41 billion and immediately treat it like locked-in software revenue. Read the filing. Only about 15% of that is expected to be recognized over the next 12 months. NAND does not magically become a subscription. And the contracts cut both ways. They defend the downside, but they also hand some of the upside pricing back to the customer. Add in that a handful of hyperscalers drive most of the data center revenue, and the backlog is a real strength with real strings attached. Now stop and ask yourself the only question that actually matters with a stock like this. If SanDisk dropped 60% over the next month and a stock up 1,000% absolutely can, would you be buying more? Be honest. Because if the answer is no, you don't own SanDisk. SanDisk owns you. That's the discipline gate. Conviction isn't what you feel when the chart is green. It's whether you understand the supply cycle, the Kioxia dependency, and the contract math well enough to add on a brutal drawdown. If you can't, then this isn't an investment for you. It's a momentum trade you're renting, and you'd better know which one you're in. So here's the verdict, split into the two decisions we started with. On the sector, SanDisk is a 5-star fit for the AI infrastructure thesis. NAND is the storage bottleneck of the entire AI build-out, and 2026 is the first year data centers overtake mobile as the biggest NAND buyer. That's structural, and it's real. But on the price, watch the trap carefully. After the latest earnings, analysts re-rated the stock hard. The average target is now roughly $1,460 to $1,500, right about where it already trades. A lot of people hear that and relax. Don't. The street isn't telling you SanDisk is cheap. It's telling you the stock is fairly priced on exactly one condition, that a 78% gross margin keeps printing. Strip out that peak cycle assumption, and the low end of that very same analyst range drops down near $1,000. So, you're not being handed a bargain. You're being asked to pay full price for what may be the best quarter this company ever prints, with no margin of safety if the cycle turns. That is the disqualifier. So this becomes a watchlist name, not a chase. Here's the discipline. Trigger 1. Price. A sharp drop of 25 to 30% into roughly $1,000 to $1,100 earns a first tranche. Trigger 2. Fundamentals. The fiscal Q4 print in mid-August 2026. If revenue guidance holds and gross margin stays in the 79 to 81 range, that confirms the cycle has legs. Trigger 3. A new multi-year contract that expands the backlog. And every quarter, watch 4 things. NAND contract pricing from TrendForce, any competitor announcing new fabs, the gross margin trend. The first quarter it rolls over from the peak is your de-rating signal, and whether operating cash flow finally catches up to net income. One variable decides this whole thesis: supply discipline. Track that, and you'll know before the crowd. So, here's the one-sentence version. SanDisk is a stock you're allowed to own, just not at a price that already assumes the cycle never ends. The sector is qualified. Today's entry, priced for perfection, is not. Put it on the watch list. Wait for a real pullback or an earnings print that proves the margins can last, and buy in tranches. Never chase a vertical chart. If this breakdown helped you separate the company from the price, hit subscribe, because that's the only thing we do here. Separate the real business from the hype. This is for education only, not financial advice. Always do your own research.